I got this shot this morning when I was running. Freaking fantastic. Probably one of the best photos I've ever taken.
Oh, really? That's great. Sorry about that. Yeah. So is that your hobby outside of this? I mean, you live in Colorado. What else do you like to do in Colorado?
Um, so we definitely got into skiing when we got here. So I've taught all my kids how to ski, which has been fun. And let's see, I've done some mountain biking, a lot of running, road cycling. We try to get up and do camping and hiking and stuff, but God, sometimes it's hard to get out despite how close we are. So we keep busy.
All right.
The usual suspects.
Oh yeah, dude. I feel this. Yeah, I feel the same way because ever since we moved to Utah, it wasn't until the pandemic that we actually started, like my family and I actually started to, like get out in the mountains and hike because like I'm from Iowa and there's not a whole lot to do outside in Iowa besides like, farm and stuff. So, so we definitely explored. That was one of the benefits for our family.
hmm Yeah. I mean, you got to get out,
So
right? We decided to live in a small town
yeah,
here,
absolutely.
so that's a lot of fun. The kids, you don't have to worry about a lot of stuff that you have to in larger cities or big suburbs. Kids can just go do whatever. It's great.
Yes, absolutely. Absolutely. Well, Jesse, thanks so much for coming on the podcast. I appreciate that we were able to put this together in such a short time. So I appreciate you. And so I guess to start, like, let me get like your background and I guess your story. So you're the owner of Sweater. You're the CEO and co-founder of Sweater right now, which I thought was very interesting. So we're definitely going to have to talk a lot about that. But like, how did your journey in business start? And where did your love of like entrepreneurship come from?
Yeah. I'll give you the quick story on Sweater. And, for those that don't know what Sweater is, let me tell you a little bit about Sweater, just intro, and then how I
Mhm.
got to it. So Sweater it's the first venture capital fund that anyone can contribute to. So today, if you want to put money in a VC fund, you've got to write like a $500,000 check. It's very out of reach, even for accredited investors. And so our objective was to break that down, and create something that anyone could get into. So put in $500 instead of 500,000, and create the same opportunity for everyone to be able to make money and grow their wealth in the same way as the wealthiest people do. So we're delivering it as a mobile app. So it's kind of like Robinhood, mobile first kind of an experience, but
Mhm.
you're getting into private companies instead of public companies. And it's all fully managed. So you don't have to go and vet your own deals or try to decide if a company's any good. We do all that professionally. We invest alongside other VC funds in venture quality deals. So we're excited about it. It's there's a lot of potential, and it's a pretty sexy asset class that people haven't been able to get good access to. So that's the basics of Sweater. We just launched a wait list, and we'll be live, ready to take money from the public in early 2022. So the way we got there, though, it's kind of an interesting story. I was previously stationed like I was in the military. Used to live in Phoenix. Was there for a decade, and I worked in the startup ecosystem there in a few different capacities. Worked for some private companies individually, helped raise money and stuff. Worked for a VC accelerator that later actually raised their own VC fund. But there wasn't ever really capital dedicated just to Arizona. There's a couple of angel groups, and there are a couple of VC funds there, but they don't tend to invest much in Arizona, especially at the seed stage. And I got kind
Mm.
of, I finally just said, I'm tired of waiting for someone else to do this. Why can't I be the one that makes the fund and actually start seeding deals here the way that, like Kickstart started things about 12, 13 years ago in Utah, right? And started laying foundations for what Utah has become. So
Yeah.
I
Yeah.
started this journey of creating a fund. And a couple of months into exploratory conversations and getting oriented, hit me like a ton of bricks one day that I wasn't allowed to invest in my own fund because I wasn't accredited. And I was like, wait. I'm the guy running the fund. How could I not invest in the fund that I am operating? And I was baffled and curious. So I decided to dive into it and understand the why behind it instead of just knowing the rules, like the why behind the rules. And as I dug
Mhm.
in, it's some boring stuff with the 1940 Investment Act and the 1933 Securities Act that no one ever wants to read. And as I got oriented, the underlying tone kind of made me upset because it basically says if you're not wealthy, then you're not smart enough to understand this stuff, and we need to protect you from it. And I that just set
Dang.
me off. I was like, that's pretty ridiculous. Like, I get it, maybe back in the 40s, even in the 70s, like access to information wasn't good. Like, you could get swindled. But today it's totally different. So much access to information, so much technology to allow us to do this. And I just said, there's got to be a better way. And that was 3 years ago. And so here we are.
Yeah. So how did I mean, how are you, because I've heard of a few other like people kind of trying to circumvent this accredited investor. I think I'm with you, by the way. Like, I think it's very dumb because we're in the information age. Or I mean, at least we're close enough to where like I can learn about this stuff. Like, if you really wanted to learn about investing and venture capital, like, you don't have to go to college. You don't have to um, hire expensive coaches or financial planners. Like, you can learn the basics of it and understand
Mm-hmm.
what's going on. And so, I mean, so because I've heard of it, a lot of other companies kind of like, sidestepping this accredited investor stuff. So how are you guys planning on doing that? Or like, what's kind of like the science behind all that?
Yeah. So I'll tell you what I can
Okay,
before we
deal. All
launch.
right,
I mean,
deal.
once we launch, then
Yeah.
everybody will know how we're doing this. But first of all, we're not like taking advantage of a loophole. We're not,
Okay.
often it's said, getting around the law. We're not doing anything
Okay.
like that. Everything's super legit. And we're actually using a fund structure that's been around for 40 years. It's just used in different
Okay.
contexts. So a little bit of history is helpful here, and I'll try to keep it brief and not boring.
Okay.
So
All right.
this really goes back to the 1940 Investment Act. So the 1940 Investment Act is like this big umbrella, and it touches every financial instrument in the U.S. So any type of investment opportunity is regulated by the 1940 Investment Act. But underneath it, there's all these silos and these different, they call them exemption sets, and fund frameworks that are pre-approved by the SEC for specific purposes and with very specific parameters. So back in the 1940s, there weren't very many of these, but today there's a lot. They've been created over the course of time. Venture capital is one of them. So underneath this umbrella, you have this subset of venture capital. And it was really born out of the 60s and 70s, when like HP and Intel were kind of being born out of Silicon Valley. Those companies were initially funded just by wealthy individuals putting money in directly, kind of like angels, right? And after these things
Mm,
started working, these guys looked around and said, well, wouldn't it be great to pool our money and actually do this, more formally? And when they went to do that, they found they had to deal with this 1940 Investment Act that has all these really onerous oversight requirements and everything. And they basically said, they went to the SEC and said, hey, we're big boys. We can lose our own money. Why don't you let us create a fund structure with less oversight and look at all these great things we can do? And, pointing to Intel and HP and stuff, we can do more of this if you'll, take the reins back a little bit. And so the SEC said, sure, that's fine. But in return, you have to be accredited or qualified investors to be inside your fund structure. And you can only have 100 people in your fund. And those were the restrictions that created venture capital. And that's the way venture
mhm.
capital has been for the last 40 some odd years. So enter us looking at that. And what everybody does is they look at that venture capital exemption set and they're like, there's got to be a loophole in here somewhere that allows retail investors to somehow get involved. And there's just not. A lot of people are familiar with crowdfunding, and
Mhm.
crowdfunding is a totally different silo. It's got its own set of rules, right? And it allows individual people to invest directly in a company, and there's very specific parameters around how that happens. So when we started attacking this, and one of those parameters is you cannot use crowdfunding to create a fund that is managed. It's against the rules. It's
Mm,
explicitly stated you cannot do that. So they're basically bulletproof. So one of the questions we asked was, well, what if we don't try to work within those frameworks? Is there a different fund structure altogether somewhere else underneath this umbrella that already exists that allows us to take money from retail investors and invest it like a VC fund into private companies, but not actually be that same VC fund designation? Which this all sounds terribly boring, but the short answer is yes, there was, and it took us 2.5 years of discussions with the SEC to identify a fund structure that they were comfortable with,
wow.
and we're in the middle of finalizing all that right now. So yeah, it's the fund structure's been around forever, and not forever, but for 40 years, and we're just applying it
Yeah.
a little bit creatively.
That's great though. I mean, that's kind of what that's kind of what 2021 and going forward is all about, is like helping people who normally wouldn't be able to like get involved in this stuff because of whatever reason, be able to get involved in this stuff. I mean, that's like, so I heard a statistic once, because I'm big in like the finance and accounting world and stuff like that. And so I'm glad that you explained it and made it simple. Like that was one of the simplest. I wouldn't have been able to explain it like that. But it's so interesting. Like I heard a statistic once that like that's like how a lot of people get wealthy. Like, I mean, there's like traditional routes of like, working and saving and all this stuff. But then there's like what do you do when you invest, and how can I have more control over my investments, and how can I just do this like kind of on my own, right? A lot of people want that like autonomy back. It seems like that's what you guys are going for.
Oh yeah. Well, I mean, this whole GameStop situation, and Robinhood thing that happened back in February. Oh man, that created tailwinds like you wouldn't believe, because it
I
brought
believe it.
to the forefront of everybody's minds, like, wait a minute, there are two games being played, right? And I can't be in that one. And part of the backlash from the Wall Street Bets group and everything, it was really, I mean, like, how about this? If all those folks in the Wall Street Bets group could have had the opportunity to put their money in those hedge funds that were shorting GameStop, I can almost guarantee that if they could actually access those funds, they probably wouldn't have behaved the way they did. But because they were locked out of it, and there was also perceived, bad intent, so to speak, by shorting these stocks and stuff, right? It upsets a lot of people. And when we talk about the wealth gap and all that stuff that's ever getting bigger, right? It's kind of like, well, guys, look around. Like, look at all of these asset classes that the rest of us can't get into, and they outperform everything else. Of course, the wealthy are going to keep getting wealthier, if for nothing else, just that. And so, why can't we have access to the same asset classes? If we want to solve this problem or at least slow it down, we need at least to be able to invest in the same assets. And so that's part of what we're breaking down. I mean, my prediction is 10 years from now, we're not even going to recognize the financial system, the investment opportunities that we're going to have. And the way the playing field is going to be way more level and open than it is today. And I'm not just talking about like crypto and more of the extreme ends of the financial fiat world, right? I'm talking about all the traditional stuff that currently exists. It's all going to be open 10 years from now. It's going to be a very different consumer experience.
I believe that. Well, and you're preaching to the choir on that one, because there's no way it stays the same. I mean, I think with the one cool thing about GameStop, I was following that stuff pretty close. With all the Wall Street Bets, I was a part of that Reddit group, and I mean, I never get on Reddit, but like when I was like getting on stuff and I would like follow them, but I followed that pretty closely and like the huge stuff, and it can't be the same anymore. Like that was the one thing that showed us like, dude, this isn't fair. Like, so of course we try to do something to, figure this out, and or like at least show you that like we're going to disrupt this whole system. That's why I liked it. I thought it was really fun to watch.
Oh man, and it was a major flex by the retail family, right? Against against the big institutions. And we've got some pretty close friends that are very tied into the upper echelons of the finance world and Wall Street. And the last 6 months have been like hell for those guys. I mean, they don't know what to do. Like they all look around and they have these investment strategies that they've raised money around that everyone is afraid of betting the way they've bet in the past, because they don't know if they're about to get screwed. I just saw a stat yesterday that since February, January, February, when that whole Wall Street Bets thing started, that there's been $12 billion in losses against, in this whole hedge fund industry, because of all the meme stocks and everything else that's going on and all the coordination on the retail side. I mean, they're flexing hard and it's not going away. I suspect that we may see some more regulation around this to help create less volatility in the market, because if it continues this way, people get hurt along the way. Regular folks, they get caught in the wrong part of the cycle and they do lose money, right? And so I don't think that the SEC really loves that. And I do think that they're going to create some different parameters. I don't know how, without making everybody really upset, but it's on the table. You got to know it's on the table.
And that's the kind of thing is like, that's where it's hard for me. Like with a lot of this stuff is like how much regulation is too much regulation, but I understand that we need some, and it's just weird. That's probably a whole nother conversation by itself, right?
Yeah, exactly.
You know what I'm
But
saying?
yeah, but I mean, the long run, it's all trending in the right direction. It's trending for consumers, and
Hmm.
that's Sweater's whole objective, right? I mean, like we exist to open up an asset class that's been closed off since it was created, and
Hmm.
fundamentally, bring more money around the table and create a seat at the VC table for everyday people. And that's just like VCs, and not take table scraps and things that are leftovers, but actually be in the middle of it and be leading deals and co-investing with other great VC funds, and purchasing up secondaries, and really creating a very I mean, safe is relative, right? But a
Hmm.
well diversified approach to being inside venture. And it's like one of the things that's interesting about the way Sweater is set up from an investment thesis perspective is it's kind of like a cousin to a mutual fund in the way that it will operate. In that
Hmm.
we can take money into it. It's evergreen, so we can take money into it forever. So a typical VC
Hmm.
fund raises a certain amount, right? They might go raise $100 million, and then they have that
Right.
100 million, and they have it allocated to go and invest in, say, 30 companies. And so when they play inside that box and say we've got to have 30 companies, these 30
Hmm.
companies have to make the fund. And so they're extraordinarily selective, and they have to be able to defend themselves. The VC itself, the GPs, have to turn around and defend their position to their investors and the decisions they made to put those specific companies in there. And there's this whole thing
Hmm.
called power laws, which basically says it's kind of like the 80-20 rule, right? 20% of the portfolio of those 30 companies is going to return the entire fund. Everything else is either going to be total losses or barely get your money back, more or less. And so if they miss out of those 30, and they only have 10% or 5% of those companies that are outsized, they may not get good
Hmm.
returns. So in the way we're doing it, because it's evergreen and we can raise money forever, we're not constrained to only investing in 30 companies. We can invest in 300 or 3,000 over time. And so that
Sure.
creates this
Yeah.
very diversified approach that just doesn't exist in venture right now.
Yeah. Well, and that makes a lot of sense and kind of really cool. That's actually a really cool way to do it, because when you look at like tech is a big one in Utah. Like when you're talking like up north or more central south, with all these tech companies and SaaS companies. And I've always wondered, like, how they get their, how they choose and stuff like that, because it's a very foreign world. Like if you're, I mean, I work in SaaS and I've worked in tech, and I've learned all this stuff, but experiencing it is really different, right? And
Mm-hmm.
that's really cool that now you can let people experience. So, man, when this launches, I have a ton. I want to dive deeper, because I know you. I know that you can't tell a whole lot, but it's really cool. That's a really cool way to do it.
Yeah, thanks. I mean, we're excited. It's I wish I could talk more about it right now, but overall, it's just you know, it, we're not out. I mean, like, to be clear too, like we're not out to like take down venture capital or like disrupt the industry. That's not our purpose. Like, I mean, traditional VCs are going to stay around, right? We're just one more player in the market, and we bring some unique advantages to the table. But like what
Yeah.
we say is that venture capital hasn't reached its full potential yet, right? It has an outsized impact overall on the industry and on the world because of the way that companies grow and have an impact on in the long run. But like on a scale of 1 to 10, the way we see it is like, well, it's at like a 5 or maybe a 6 out of 10, right? And what's missing
Right.
from our perspective is it's retail money and it's retail engagement in the process.
Hmm.
So like
Hmm.
when you examine effectively the strategy of how companies are built today, it's basically find a great team that has a great pain point and concept that they are solving, right? And a big market opportunity.
Hmm.
Give them a war chest of money to go out and conquer the world, right? And then, they sit in their bunkers and they go pew pew pew, and they try to get customers, and they're attacking the whole world trying, if they're focused, they'll be very narrow in that. But generally, you're giving them a war chest and say go to work,
Yeah.
and try to get the world to come to you. And what we're saying is, well, what if we brought the world to the startup? I mean, we're going to have
Yeah.
hundreds of thousands or even millions of investors, And so when we make an investment in a company, we have hundreds of thousands of people who are now part owners in that company, and they have a vested interest in helping to make it successful. So when it comes especially to the earliest stages of actually helping a company find success, we believe that we can reduce the risk associated with that and accelerate the amount of the time to market, and reduce how long it takes in order to find product market fit and actually establish yourself as a company. And so like we look at things like that, and it's like there's a chance, right, at scale, that you can fundamentally change the way that companies are built and taken to market. And we're excited about that, right? I mean, that changes the fundamentals of the whole venture game, if we can pull it off.
Oh, for sure. I mean, that's just the coolest thing. And this is why I love interviewing business owners, especially like yourself, where you're like creating something new and starting something different, is because you have this idea and it's really going to help so many people. And when you're somebody who has all of these ideas, or you want to start like growing your wealth, like maybe you're in a good place to really start putting your money somewhere, it can be kind of boring to go like 401k, IRA and stuff like that, because you want to like invest in these companies. Like I love investing in small businesses. So with like self-directed IRAs, or like, just some other stuff, because that's the cool thing, like seeing like small business and medium-sized businesses, or like these tech companies who are changing the world, seeing those guys' visions and being able to help them, like that's really cool in my mind. And it seems like that's what you guys are doing. So, I mean, aside from, the companies that'll be in there, will the consumer have a lot of options as to like where they can put it? Or is it kind of like I guess essentially needs to go?
Yeah, so it's starting out fully managed. So when people make a contribution, we pool all that money into one fund, right? And then we professionally manage that, go out and look at opportunities and make investments on your behalf. But part of the mobile experience is that we showcase that process and involve people to an extent that we can, in terms of gathering opinions, understanding what's going on. Like we're even, here's an example of how we like to say it, right? So it's like it's as if all us retail investors, all us non-accredited, it's as if we had only ever been allowed to watch the NBA at home on TV. That's what we could do.
Oh, okay.
It's a good experience. You get to kind of watch it, right? But what we're saying is we want to take you to the stadium, give you courtside seats, and tell you you're a part owner in the team that's playing, right? I mean, it totally changes the feel of what you're doing, right? And if you're really, really good, we'll let you be that kid that sits under the hoop and gets to go wipe sweat off the court during timeouts, right? You're not shooting the ball and you're not coaching the team, but you're right there. And that's the experience we want people to feel, right?
Yeah, yeah. Which is great. I mean, I still think that's better than any alternatives that we have right now. That's incredible. That's amazing. So how did this all I mean, you kind of started the story of how it started with you personally going down the rabbit hole, for lack of a better term, and kind of like researching all this stuff and really asking questions. But how did it start, and how did it really get off the ground?
Well, I mean, the number one barrier was trying to figure out what fund structure we could use for this. And we knew that, investors wouldn't give us any money until we figured that out. And so it was a long haul. I mean, this is one of those areas where it's good to know the right people. And not from like a mobster kind of know the right people, but just like, there are folks that understand more deeply how these big government systems work and who the right people are inside that, can understand what you're working on. And so we finally got around. I mean, it took about 1.5 years to get introduced to someone who had previously been at the SEC for about 5 years. And he had just come out and made partner at a law firm called Brian Cave. And we got connected with him and, explained it to him. And he's like, oh, I know exactly who to talk to. And they have this special process that's not published anywhere. And, like we can get you in here and get it all organized and have you talk to all the right people. And I'll make some phone calls. And I mean, from the time we had that conversation, it took almost 10 months from the time we met him until we actually had those conversations. It took forever. But and to know, not his fault, right? This is just the government you're working with. And so by the time we got all the right people, Yeah, and so we got all the right people in the room, explained what we wanted to do. We had our own thesis, and they came in prepared with their own ideas, which was great. And so we had a lot of back and forth. We examined a few things, and we actually ended up going with one of their suggestions. We found some things that they weren't even aware of as a group. The SEC in its entirety knew about it, but they didn't. They weren't aware. And so we had some back and forth and identified that. And that was back in October, November. And they effectively gave us what we refer to as a green light, which is, yes, you can use this fund structure for these purposes. So all you need to do is get registered for this fund, which is a very expensive, long, and arduous process in and of itself. But we knew exactly what we had to do. And at that point, we had what we needed. It was the holidays, so we waited until about February to start fundraising for not for the fund itself, but for Sweater, the fintech company. Just like any other startup that you would raise money for. And so we just closed that up. We oversubscribed our round. And now, so we raised 2.3 million, which has been a great spot to start. We've got a team of about 12 now working on stuff. We're building out the product. We've submitted to the SEC. We're building out a VC partner network. We've got 6 VCs on board to co-invest with. We're building out a scouting network right now for our retail investors to be able to participate and find opportunities to invest and bring them to us. And we just kicked off the wait list last week. So lots of stuff is rolling, and yeah, it's all very positive.
Yeah, that's great. Well, I'm on the wait list. I'm kind of far down, but I'm there, man. It's sweet. That's really cool. So, and I read, because I follow you on LinkedIn, I've read a few of your posts that talk about how, your kind of journey in entrepreneurship started almost immediately. You were talking about on a post how, you had your degrees, and then, you got your MBA and all these things, and then you just kind of started your own business. So for people who, let me ask you a big question. I commented on your post about the whole MBA thing, and I told you my experience, but in your experience, what is the future of MBAs and education? What does that look like? I talk to everybody who has it now, and they're like, it's nice to have, but I don't have one, because I was just I had some revelation. You know what I'm saying? So but for you, what's kind of the future of this whole education and entrepreneurship relationship?
Well, in general, I think there could be a couple of different ways to discuss that. I don't think that it's a trade-off between education and entrepreneurship specifically. I think that that is one option, but the difference between education and having the credibility you need to advance in a career, that's, I think, the strongest correlation, right? So today, it has been, until, we could say today, maybe 5 years ago, that if you didn't have a bachelor's degree, you couldn't even apply for most high-paying jobs, right? And then eventually you would most likely, not guaranteed, but you would most likely hit a glass ceiling at some point, where you then had to have an advanced degree in order to be qualified for management and special projects and these other ultra high-paying opportunities. But that's shifting. More and more, especially with so much information that's available online for free, that you can self-teach and become an expert in something without ever going to school. And schools are behind the times. I've had lots of discussions with universities that I've attended. I'll just leave names off the table for now, about being more advanced, especially around things like digital marketing, and saying why don't you have a digital marketing emphasis, not marketing, digital marketing, how to actually run Facebook ads, how to be the best in the world at doing this, to be able to sit down and run a $10,000 or $20,000 a month budget. How do you scale that to a $250,000 a month budget? How does this stuff work? How have things evolved from the history and understanding it, so you have context? Nobody teaches that stuff. And it's how on earth are universities not teaching this? This is what's running the world now. I haven't looked at the stats for a while, but if I'm not mistaken, digital advertising has outstripped traditional TV and digital out-of-home advertising for the last couple of years. So most marketing is done on the internet, and no one's teaching classes. Are you kidding? It's ridiculous. And so I believe higher education has a reckoning coming. And I mean, the big tech companies are already saying you don't have to have a bachelor's degree to apply now. And I think that's
Mm-hmm.
complicated, right? I wouldn't say it's misleading, because I think that opportunity to not have a degree and still qualify to work at Google there's a big gap there, right? You can't just walk out of high school
Yeah.
and go apply at Google, right? But if you didn't get a
Right.
bachelor's and you've worked for 5 or 7 years and you've become an expert, you can apply and work at Google with no degree, and
Right.
especially
Right.
engineers, right? And I think that we're going to be shifting more from a credential-based system to a skills-based system, and it's going to take a
Mm.
long time to transition, but I think it's going to happen, and I don't know, like everything's just so overpriced, and you're coming out of school laden with debt and all this stuff. I mean, I don't know.
Yeah.
It's complicated, and there's no guarantee of which direction it will go. But
Yeah, it's true. For me, that was the big thing, was like education isn't necessarily like traditional formal education necessarily isn't a bad thing, but it's it's the it's the ticket. It's the cost, right? That kind of is throwing us off for a loop. It's like it's just like what I mentioned, on your post, but I've mentioned it a few times. It was like this guy told me, he looked me right in the face, and he was like, if you had 30 grand, which was the cost of my MBA, if you had 30 grand to spend on yourself, would you go to college? And I was like, heck no, I wouldn't go to college with it. I would, and
yeah,
I mean,
exactly.
that answer might be different for everybody. Like that was a personal experience for me, right? Because some people might take that and go, and that's fine. But for me, it was like, no, I'd want to like learn other skills and gain experience that I know that would take me further. Because yeah, like you don't have to have a bachelor's degree, but you have to have, like, what did Elon Musk say? Like exceptional, like qualifications, like, or exceptional proof. You know what I mean?
Yeah,
Which is
exactly.
fair. That, and so, and then that brings up, this whole idea of like, job hunting, but we don't have to go there. But that's interesting, right? Like that's super interesting, because I've always just been, kind of, you look at it, right? You go, who's where I want to be, and what do they have, and how did they get there? And then I'm going to try to do that, right? And it's just kind of all over the place.
Yeah, exactly. And, there's always, just like all these things, there's always going to be a place for MBAs. There's always going to be a place for PhDs and undergraduate degrees. There's always going to be companies that are going to require that stuff. I don't think that it will ever go away.
Yeah.
But I do think that there are going to be alternative paths that become very viable options, and better, more formalized way of gaining skills instead of degrees. And I'd say I've yet to see a formalized way to get that done efficiently and at any kind of scale. But I think it'll happen. It's ripe for disruption, as many say.
It's ripe for disruption. Yeah, it really is. And I'm excited. I've talked to a few people in kind of like that disruption education space, and it's pretty exciting to watch that whole for sure. So what is your like, I like to talk about books. I mean, I'm sure like you see some in my office here, but I'm like, I love books. What's a book that you recommend to everybody, especially if they want to start a business, or maybe they're getting out on their own and stuff like that?
Oh, 100%. Shucks, what's it called? It's a negotiation book. I got it on my shelf. Where is it? Never Split the Difference.
Oh,
I've read that book like 5 times. And
everybody should.
It's the best book I've seen for business and life, like to actually get ahead, and not in like a selfish or devious way, but like in a natural way to get what you need and want without being rejected for unnecessary stupid reasons. And it's like, it covers like basic everyday stuff, but it's bigger stuff like salary negotiations and closing big sales and doing like real stuff. So I appreciate that book. I think that it's extremely rich in its content, and it's real world. That's the thing. Like so many books that are published out there are written by, no offense to any of them, right? But they're smart books that explain studies that have been done. Like Like Jonah Berger does a lot of this, right?
Yeah.
And looking at things like Blink and,
Yeah.
and Malcolm Gladwell, like smart books, incredibly smart, right?
Yeah.
And they're great at it because they take other people's studies and then they digest it and give their own view of how all that stuff actually works in the world. Um, but the
Yeah.
thing about Never Split the Difference is it's from 30 years of in the field negotiations being taught by the person that did it, and that's very different than a study. And so that's one of the reasons I love it. Is it's so applicable and so real.
Yeah. Yeah. Real world advice. I love that book. And I actually went and, masterclass. Chris Voss had a masterclass on their website, and he's got the Black Swan. Dude, I love that guy. Plus, interesting note about Chris Voss. It's so funny. I brought this up. It's a really popular book because I asked this question 2 interviews ago, and they said the same. But yeah, I grew up right where Chris Voss grew up. So he grew up in Southeast Iowa, and so I remember
Cool.
Voss Petroleum and stations
Really?
everywhere, and yeah, it was actually it was pretty cool.
Yeah, that's awesome. I mean,
Yeah,
another one
so,
like specifically for startups
okay.
is The Hard Thing About Hard Things.
Oh
Um,
yeah.
by Horowitz. What's his first name? From Andreessen Horowitz, A16Z.
Yeah.
And I mean, that guy, holy cow, he went through the ringer as a founder, like in a crazy way. I mean, he founded his company like right before the dot-com bust. And he was one. So like, I think I'll probably get the years wrong, but it was like in 2000, there were like 350 IPOs of tech companies or something like that, or maybe just overall. And in 2001, there were like 23. And his company was one of those 23 companies that went public. And so, and after that, of course, everything was just collapsing. Their market was in many ways to the startup world. So as all these companies are going out of business, they were just losing revenue left and right. They were a public company now. And he had to reinvent that company from the top down and somehow survived and still sold it for a couple of billion, 6 years later. I mean, like absolutely crazy. But the thing that I love about it, besides it being real, and again, not theoretical, right? Being told by the person that went through it, is that it's it's not focused on the strategy, the traditional notion of strategy in business. Probably, I would say the vast majority of it, probably 60-70% of that book is about people and how you manage and inspire people inside a startup environment that is often volatile and difficult to manage when you're the founder having to make hard choices, and how you facilitate that. Because I mean, he had points where he had to fire 70% of his staff. So the thing you don't think about is like, well, that's a crappy experience having to fire 70% of your staff. But the bigger problem is, what do you do with the 30% that stay? And how do you convince them to stay and actually be productive and help rebuild the company? Because they're scared to death. I mean, imagine like 7 of your friends just like walked out the door, like, and you're left. You're like, oh my gosh, I got to get out of here. Like I'm next. So like, what do you do in that scenario to maintain morale and actually be able to inspire people to do what's necessary? I mean, it's real. And so I really appreciate that book. Matter of fact, I'm going to put that back in Audible and listen to it again. It's been a couple of years.
You should. I mean, I remember I read that book for the first time 2 years ago, but hadn't thought about it until you just brought it up. So I'm gonna have to read that again too, man. I appreciate that.
Yeah. One more too that I want to like specifically for founders. There's a couple of them that kind of cover the same stuff. One is called The Founder's Dilemma. And I think the other one is called Founder Pie, maybe something along those lines. And it's the whole notion of how you determine equity splits between founders. And this area of all areas is probably one of the most contentious things that destroys teams, is negotiating equity. And it's
like negotiating equity when you're selling, like when you're raising, or like when you're starting the company.
No, when you're starting. So, you and 2 buddies are going to start a company and you say, well, there's 3 of us, let's split it 3 ways. And then you go and start the company. And then, one of you quits your job and you're full time on it. The other 2 keep their jobs. They're working nights and weekends. One of them is only putting in half as much time as you thought, and they're always taking vacations. You're putting in both time and you put in $50,000 and they put in 5. and you get 6 months down the road and you look around and you're like, I'm doing way more than a third of the work and a third of the risk here, and
Right.
that creates conflict, right? So the way that you start that conversation and the expectations you set between founders moving forward is just incredibly important. Um, and it actually is a really, like, for me personally, it changed the trajectory of some stuff I was working on with Sweater. And so
Yeah.
it's absolutely critical, I'd say, to understanding how to do that. And like one of the things that's really interesting, is being able to examine like what timeframes different people are going to be adding value to the business. So out of the gates,
Mm.
it might be the engineer, the product person that's actually building the thing so that you can go and sell it. But after that point, it might be the sales person, right, that's going to go out and actually generate revenue. But they're not happening at the
Right.
same time, and so, is one person taking more risk than the other? And one of the most eye-opening concepts for me was once you negotiate this, it's not set in stone, right? Like you can
Right.
change equity structures and you can have that conversation, And so um, I think it's something a
Wow.
lot of founders don't understand. They get upset about the position that they're in, the risk they're taking, and they never consider that you can renegotiate and have a better
Negotiate.
position.
Yeah.
So it's just incredibly enlightening. And one of the reasons that it's also
Yeah.
enlightening is because the guy that put it together, I think he studied like 700 funded companies. And, between those 700, there was like 1,500 founders that they
Oh,
examined how
wow.
they started with their equity and what happened to their equity distribution and the founders over the first few years of the business, and examined all the
Wow.
dynamics of what went wrong and all that kind of stuff. And so it's very informative. Highly recommended especially if you think that you're going to start a high growth business. But if anything else, basic rule, never just split it 50-50 or 30-30-30 or whatever, right? Just you have to
Yeah.
have the tough conversation on day one and say, what is everyone bringing to the table? And it's like one of the
Mm.
things, it's like if you got the idea, if you're the idea guy that started it all, you get a 5% bonus off the top, right? And then from there, you create more like an equation to try to determine who is adding what value along the way, including, financial, time, reputation risk, offsetting salaries,
Yeah.
like salaries you're giving up,
Yeah.
like all that kind of stuff. And you come up with a formula that everybody agrees on, come out the other side, and then you have an answer, right? And all you can do is argue with the formula instead of arguing your emotions. It's logical.
Right. 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 Yeah. That makes. Whew. That's a lot to unpack. But that's important for people to know though. Like, because if you're in a partnership, I mean, I learned after starting two businesses with partners was the one that you mentioned, like never split it 50-50. If you go into a partner with somebody, and I always just assumed that never split it 50-50. I mean, I'm sure this is part of it, but because of like, if you have two partners, it's just like voting rights too. Like, somebody has to have the final say. Like we can't be stuck in like a stalemate. Like somebody has to pull rank. Like if there ever comes a time
Right.
where somebody has to pull rank and like make the decision, like we have to do that, right?
Mm, yeah, totally, man. We could talk about books all day.
Dude, I love it though. Cause I mean, do you feel like, I mean, for entrepreneurs, gosh, dude, I mean, I've talked to a ton, not necessarily on the podcast, but I've talked to a lot who just don't see the value of, like, I don't know, maybe books specifically. I mean, you're always learning and you have education, but nothing like a good book in my mind. So I appreciate that. I appreciate your input on that. Well,
Mm.
I appreciate your time being here. Like, I don't want to take all day from you, and especially on the weekend. But how can people? I mean, I think I left the website in the link here. But for you, like, how do they follow you and get a hold of you if they want to get involved, or what should they do?
Well, for Sweater, you can just go to sweaterventures.com and sign up on the
Okay.
wait list. And we're having some fun with that, right? So we've got a ranking system, and when you share with your friends and they sign up through your link, you go up in the rankings. It's pretty fun.
Yeah, it's
And
a
then we keep you
genius
updated as.
idea.
Yeah, it's good so far. So we'd love to have people sign up and follow our journey there. And then for me personally, I don't like they don't really have like handles and stuff on LinkedIn. So if you just Google Jesse Randall sweater
Yeah.
LinkedIn, that I'll pop up. But yeah, I mean, I'm in Boulder, Colorado. So if you want to look me up and follow, I'm fairly prolific on LinkedIn. I do like posting a lot of good content and, trying to keep things real. I'm not one to self promote too much, but life is complicated and we all have a life outside of work. And that's kind of some of the angle that I like to take is that,
Yeah.
we're all human and we all need to talk about these other things that are important.
Oh yeah, absolutely. And like I said, I love it. So I'll keep doing it. Well, I appreciate you coming on, like I said, and I hope you guys crush it. I can't wait till Sweater launches, brother.
All right. Yeah. Thank you. Well, we're excited too. Get it in your hands.